Which brings us to our talk of the tape. With economic growth concerns weighing on investors' minds and a crucial Fed meeting underway, can Jensen Huang refocus investors on the big picture of tech innovation and light another spark under the faltering AI investment theme? With me to discuss is our very own Christina Partsinevelos, live from NVIDIA's GTC event, Capital Area Planning's Malcolm Ethridge, and Deepwater's Gene Munster. Malcolm, a CNBC contributor. Welcome to you all. And Christina, let's start with you. And what are we learning so far?
Well, NVIDIA is unveiling new strategies to maintain dominance amid increasing competition. And so here's what we learned so far. CEO Jensen Huang introduced, there's a lot. So NVIDIA Dynamo, which is inferencing software designed to scale AI reasoning models, a tumble there while cutting costs. The company as well expanding beyond its core business, announcing a partnership with General Motors to develop autonomous vehicles and providing AI solutions both for the vehicles and GM's manufacturing facilities. That's why you're seeing competitor Mobileye stock. They actually dropped on the announcement. Last I checked, it was down about 4%. NVIDIA also planning to open a quantum computing office in Boston, though you have to keep in mind whenever they talk about quantum computing, it's a minimal impact for revenue for at least about 3 to 5 years or so. Huang also talking about data centers. That's really the focus of GTC, its GPU technology conference. So announcing Blackwell Ultra for this year, Rubin, which would be the next iteration for 2026, and then Rubin Ultra, which should be out in 2027, the back half of 27. And he's promising, too, that the Rubin architecture will really drive down the cost and really comes at a time, too, when hyperscalers are nipping at NVIDIA's tail with cheaper options. The Information had a story today about AWS doing just that. And despite growing competition, Huang's confidence about the performance and strategic diversification, auto, humanoid, robots, the software, is really to show that NVIDIA is positioning itself to remain the AI hardware leader, but also move up the stack amid all of these market cycles.
Yeah,
Dynamo
seems like
is the name, by the way. I mispronounce it. Dynamo.
There you go. Absolutely, yeah. So building the case further that, there's an entire ecosystem. It's all going to be kind of integrated with software and many, many offshoots of the uses of hardware. So we'll see if it gets some traction in the market. Stock is up 10% off its low from a week ago, but has struggled for the last couple of days. Christina, thanks. We're going to get back to you in just a second. Malcolm, anything you've heard here that's either different from what you expected, reinforcing your kind of expectations as a shareholder, or what are you looking for that might be further to build the case here?
Yeah, so the really interesting thing to me is that Jensen's already starting to pivot away from data center. If you notice, as soon as we started having the conversation following DeepSeek around whether there was still some there as far as data center, or if we would start to see companies like Microsoft and Amazon and Facebook and others pull back on some of that CapEx that they promised in the data center space, Jensen's already talking now about autonomous driving as if it's here. He's already talking with other cell phone carriers about integrating the chips there instead of having them live inside of the data centers as a way to get to the mobile opportunity. So I think what's really interesting is he's already forecasting out years ahead where he sees NVIDIA still playing a real role as far as the AI revolution is concerned, rather than sort of resting on their laurels and focusing on where AI is today and where that inference is happening in the data centers today.
We should mention, of course, Malcolm joining us from Future Proof down in Miami Beach. We didn't just interrupt your vacation or anything like that, so that explains the backdrop. Gene, it all sounds great if Jensen is kind of broadening out the scope and talking about all these non-data center uses and the runway he sees there. But, man, this has been the cleanest investment story for the longest time, right? It's just like insatiable demand for those GPUs, supply constraints, the massive revenue growth. And is that becoming complicated here? Has he said anything that's going to confirm the revenue outlook, let's say, for next year?
Well, if you want to read between the lines, there was a comment about revenue outlook over the next couple quarters. He said no one should buy Hopper. He laughed and said, "I'm the chief revenue destroyer. My salespeople are going to hate me." But he says that comment because he knows how strong Blackwell demand is. There's no scenario where if he was concerned about where the business is in the current state that he would make that joke. And so I think that that's one reading between the lines, and I agree with Malcolm. I think that the bigger picture, beyond just 1 or 2 quarters, the central question here is how long is this growth going to continue? And that goes back to a comment that he had on their last earnings call about this 100 to 1 million times more compute. And by my count, he spent a third of the 2 hours building his case that we're still early in this build-out. And he talked about those autonomous opportunities, but I think the data center still is a huge opportunity for them. And so I really saw this as him reiterating his belief that we're still early, backfilling on some bold statements he made a few weeks ago.
I guess, Malcolm, that's encouraging. On the other hand, I just do wonder if the customers here, the big cloud platforms and everybody else that's spending tens of billions of dollars this year and more on trying to build out this infrastructure, if they're happy to sign up for unending cycles of this. In other words, it's not like there's no time when they can essentially say, aha, we built something, it can now scale from here. It seems like it's a treadmill.
Well, I think the biggest challenge is they have to spend these tens of billions of dollars just to compete against everyone else who's spending tens of billions of dollars to be there, right? The risk of not building and spending the money to build out that data center is way higher than it is if you spend, you overbuild, and then you don't necessarily need the capacity that you thought you did. So I think realistically, the CapEx that we've talked about is baked in and is firm for 2025, regardless of whether we have suspicion that maybe they'll want to dial that back later on. I don't think they can afford to. I think there's constant worry that my next door neighbor, Google, for example, Alphabet, Google Cloud, is going to get there if I don't spend the money, if I'm Microsoft, to protect my moat as Azure.
Gene, I have a very vivid memory of similar talk about this when it came to EMC back in the late 90s or Cisco. Or it's like, I wish we could stop paying you guys for this stuff, but we just can't. And it worked really well. But eventually the market might get a little bit antsy about the idea that it's not going to be sustained. And maybe that explains why NVIDIA's valuation has gotten compressed. What's your take on how the stock is absorbing all this?
No, absolutely. I don't think it's absorbing it very well. It is not absorbing it well. Essentially, all these positive comments, if you take Jensen at face value, the stock should be meaningfully significant higher from where we're at, potentially 30, 40, 50, 100% higher. And I think it really speaks to some of that scar tissue 25 years ago and investors just reluctant around what the ultimate growth rate is in calendar 26. Right now, the street's at about 25% growth. I think it's probably going to be 35 or 40%. But I think at the core, there's this, again, question around sustainability. And I think that there are some very big differences between now and 25 years ago. Continue to believe NVIDIA is in a good place. The question for investors is going to be, number one, immediately the narrative shifts to what are the hyperscalers going to say in 5 weeks? And second is every quarter that they don't get credit kind of pushes that gets them closer to a point where they're not going to be growing at 35% plus. And so I think that that is one dynamic. Will they ever get credit for it? I think that they will, but they're not certainly not getting credit for it today. Interesting.
Quick programming note, by the way, tune in to an exclusive interview with NVIDIA CEO Jensen Huang and CNBC's Jim Cramer. It's tomorrow morning at 10:15 a.m. Eastern Time. So, Gene and Malcolm, while we have you, want to get your takes on Alphabet's $32 billion deal to buy Wiz announced this morning. I guess, Gene, just quickly, is this deal done out of a defensive posture from Alphabet? What do you think about the strategic rationale and the financial case?
Strategic rationale is that this is what cloud customers are demanding, essentially better integration of these security features, and that's what they're going to bring. They're going to continue to sell those features to other hyperscalers and other cloud providers. And so as far as the rationale, like why now? Why restart this now? I think that it probably is a read that they feel like we're going to get into. Andrew Ferguson is going to be a little bit more lenient towards them. I think if they had some wink and a nod that this is going to be a tough environment to get a deal done, they wouldn't have restarted it. Remember, they restarted it at a 40% higher bid than they did a year ago. And so I think it's, in general, a good feature for the platform. It does increase the growth rate of, if you look at Google Cloud for next year, from about 25% to 27% with that addition.
And Malcolm, I gather you don't own Alphabet, although the stock is starting to look pretty inexpensive. What's your quick take on it?
Yeah, so I'm actually encouraged by this, assuming that the deal does go through, and I agree. I think there's no way that they would have gone down this road of creating this regulatory headache for themselves if they didn't have a really good understanding that it was going to pass through. And I think that that's going to kick off a wave of consolidation among all of the smaller cybersecurity players within the space, because they can't compete with the Palo Altos and the CrowdStrikes of the world as standalone players with such small market caps. And I think that consolidation is going to continue to happen throughout 2025 and 2026 as a result of this deal.
And Gene, I've been sort of just floating the notion. It just looks, by the way that the stock trades, whether it's in response to, Alphabet's CapEx plans or a deal like this, that the market doesn't fully trust Alphabet on capital allocation, or that they're going to get paid back for it. Or maybe it's just that their core business is like the best business ever created, and anything else they do looks like it might be a potential risk or step down from there.
So at Deepwater, our view of Google has shifted more negative, and I think it's based on a belief that we're still in a bull market with AI. We think that we're going to be much higher in 2 years than we are today. But Google trying to navigate what's going to happen around search. The search results space today is messy, and they need to simplify it. And how you do that transition on the monetization piece, it needs to be much more than AI overviews. And so that dynamic has just softened our optimism, and they need to radically innovate and really embrace the innovator's dilemma and to, I think, solve what ultimately is going to be the new search paradigm.
Mm-hmm. Yeah, it's a tough shift, I'm sure. Gene, thanks very much for the time today. Malcolm, stick with me. Big news from big tech. Not enough to save the market, with stocks resuming their sell-off after 2 days of relief. Let's bring in Citi's Scott Cronin for more on the broad outlook. Scott, good to have you join the conversation here. So it felt like last week we kind of halted this pullback at a moment where it could have gotten even messier, right? We sort of touched really oversold levels. S&P gets down to 5,500 on an intraday basis, and we get rescued by this oversold rally. Where does that bring us to at this point?
Well, Mike, it's always great to be on the call with you. So yeah, we drew a line in the sand at 5,500 a little over a week or so ago. And, there was a little bit of, thought to it. Obviously, a 10% pullback from the recent Feb 19 highs. Also, what we're suggesting here, it begins to give you a better risk-reward setup before what we've been using since the beginning of the year in terms of a bear case scenario of 5,100 and our ongoing base case of 6,500. But what I want to focus on, though, that I think kind of plays to the conversation at hand right now, is if you look at the way the S&P is pulled back from those Feb 19 highs, S&P down 10%, but this mega cap growth cohort, the Mag 7 in particular, these companies are down 20% plus from their 52-week highs to recent lows. So what's happened here under the surface is that you've begun to change the relative valuation construct to where the growth part of the market versus its history is starting to look more attractively valued. I'm not going to say outright cheap or outright inexpensive, but we're less concerned about the valuation framework now than we were going into this year. And that's different from the rest of the market that actually is still more expensive versus history. My point here is that we're getting to a juncture where you give me confidence in the growth trajectories for the Mag 7, and we think this growth as defensive component can begin to creep much more into the market narrative.
Yeah, that's exactly what I was going to get at. So there have been times when that NASDAQ 100 type profile of stock has acted as defense against macro concerns. So your take on the fact that really the downside has been driven by this unspooling of valuations in mega cap tech. Does that mean the rest of the market has not been expressing concern about this growth scare that we seem to be in, or hasn't fully accounted for it? How does that play?
Yeah, so I think it hasn't fully accounted for two things. So you've got the mega cap growth cohort is, let's call it, it's 45-50% of the index. Cyclicals and defensives, or economic sensitives and defensives, make up the balance. They're balanced out, right? So you've got healthcare up in the year, but you also have energy up on the year. Industrials holding in roughly flattish, and financials giving back some of last year's gains. But yeah, away from the Mag 7, the rest of the index is trading much more like you'd expect around traditional macro inputs, with the exception that I don't think that we've completely priced in a lot of the tariff risk, that still continues to be an important discussion point.
For sure. And Malcolm, how are you thinking about that tariff risk, the sort of policy flux that we're all facing here, and whether it's going to start to flow through to earnings estimates and all the rest?
Well, I think we've gotten a ton of proof already that the consumer is feeling differently about the day-to-day than they did just a quarter ago. I think we've gotten a ton of proof that retail sales have slowed. We've gotten guidance from the airlines now that travel has slowed. And so I think that the longer that this tariff war continues on, the more likely that this downtrend that we're talking about is to continue. So right now we're only talking about a little bit of a correction, and we keep teetering between whether it's a correction or not each day. Now we're at the risk of tipping into bear market territory for every single additional tweet or public statement that we get out of the administration. And so I think the longer this carries on, especially as we get further proof from GDP numbers, the more likely we are to be seeing something created that's a more sustained downtrend. I'm very concerned that the messaging around this, especially as the president comes out and says, I'm no longer pegging the success of my presidency to what the S&P does, and everybody's just going to have to band together and take a little bit of pain. I don't think that investors are going to be willing to agree to sign up to take that ride with the greater economy.
Right. Now, that is true, although it has been somewhat quiet on the tariff front for a couple of days. Maybe they don't mind seeing the market lift a little bit. Scott, in terms of how investors have sort of had their views of things change, I know you track a somewhat kind of market-based and slower-moving indicator of investor sentiment and positioning. Has it reset to the point, and have we even overshot at all to where people have gotten a little more pessimistic than the conditions warrant, or no?
Yeah, I tell you, on a short-term basis, Mike, you look at indicators like, relative strength, and you got classically oversold last week. However, our Levkovich index, which is our version of a broader sentiment read, continues in what we define as euphoria. Now, it tends to have a lagging component to it. We suspect that it'll probably come out of euphoria before too long, but we're quite a ways away from something that would give you a more classic, hey, this is priced in, you want to be buying the current sentiment backdrop. We're not at that point yet. And that, in turn, has us very eyes open to Malcolm's point on the way that we think the Q1 reporting period is going to play out. That's really going to set the tone, because what we're expecting is that a lot of the tariff noise has been just that, noise, not necessarily fully reflected in company guidance and analysts' ability to model it. We think as we go into the Q1 reporting period, you'll see corporates give you a little bit better spin on how they see tariff impacts playing out in terms, in turn, analysts will be able to model better. We suspect you're going to see this negative revision bias going into the Q1 reporting period. All told, we think that's where you begin to spin down the sentiment and ultimately set up for a little bit more structurally improved setup.
Gotcha. Yeah, just a few weeks ahead. We'll be right in the middle of all that. Scott, Malcolm, thanks very much. Appreciate the time today.